Okay, this is an update on the pair that everyone is always tracking and is the most important pair out there, and that's the Euro-US dollar. What I'm using right now is East Signal with the Ichimoku cloud, and this is a weekly chart. And looking back here at the time frame on April the 12th, 2010 is when the euro broke the weekly cloud, and that was at 1.35. Now we're trading at 1.19. And on the daily chart, the euro broke the cloud way back on December the 16th. December the 16th, 2009. And since then we've had one cloud touch back on April the 14th. And since then it's been an absolute collapse. And during this time over here, where I'm sort of circling, I remember Mark Faber being on CNBC saying, you know, the euro's a bit oversold, and I actually warned in the daily free commentary for a few weeks not to go long the euro. We had to try to see what was going to happen with this cloud touch. One of the ways you can trade if you're only a cloud trader is you can trade the daily cloud but also trade the Tenkan line. This is the blue line here. It's similar to a 9-day moving average. I explained it in the introductory videos, so if you haven't seen those yet, please go and take a look. And it continues and continues to hold this Tenkan line. My objective for the euro is actually 95 cents US, and I don't see any reason why that can't happen, because it's been there before. It's been there a few years ago, and at this point in time you have Americans saving, which is actually shrinking the money supply from a consumer standpoint. The only reason there's a stimulus, and they'll never tell you this, they'll say it's for jobs, but the real reason is because if there's deflation in the US economy, the United States is bankrupt because they won't be able to make the interest payments on the debt. When you have inflation, eventually everything goes up, prices, wages, and if people are making more salaries and making more money, even though it's not in real terms, their salaries go up, prices go up, government revenues go up, but debt doesn't actually go up. And that's really the way the US has been financing itself since World War I. Here's the 240-minute chart. In currency trading, the daily chart determines the trend, and the 240-minute chart is a chart that you can trade if you're not necessarily a short-term trader and the day trend is too long for you, because that can last 6 months or more. You want to try to get some fast moves. The 240-minute cloud is a really, really great time frame, and these can last for several months. And you can see here in the euro going all the way back to April, it kept holding the 240-minute cloud. Cloud test here, numerous cloud tests. And right now I actually don't see any reason to get out of the euro whatsoever. I don't see it as a bottom fish play, although what I would like is for it to break the most recent bottom, which is about 1.187. Here's the 60-minute cloud chart for the euro, and as you can see here, just a few hours ago at about 3 in the morning US Eastern Time, we had a cloud touch. And if you're a short-term trader, the 60-minute cloud is the lowest that I go to in the table that I've created. But if you want to do shorter time frames, it's always going to be best when things are close to the 60-minute cloud. So let's take a little quick look here at, I'm going to briefly look at the time. Okay, this is at 2 in the morning Eastern Time, and I know a lot of people aren't up at that time, but it doesn't matter, you know, what time it is in the world. This is just the type of pattern we're looking for. Once it touches the cloud here, you want to then look to smaller time frames if you want to try to catch a quick move. So this is the 60-minute cloud. We're looking for the cloud touch, and we're looking for a move down, and it's going to happen on the 5-minute, 10-minute, 15-minute charts a lot earlier. So let's look at the 15-minute chart. Makes the cloud pass here. 10-minute chart, and this was a good move here. So right around this area here was when it was touching the cloud on the 60, and then it passes through here on 10. So when you're looking at here, it passes the cloud, You can then even go to a smaller time frame like the 5. It's going to pass on the 5 first, so you know it's touching the big cloud here on the 60-minute. Look for a move down here on the 5, and I think that that's a good possibility of a nice move. And here's what happens. It's a move of about 40 pips, and it's not a long-term trading strategy, but it is something that you can look for a short-term strategy. Here's the US dollar Swiss franc daily chart. Now, the Swiss franc is the best currency in the world long term. We're talking 10 to 20-year time frames here, but doesn't mean you can't trade it. Brief history on the Swiss franc. It used to be in the Swiss constitution that 40% of the money had to be backed by gold, but unfortunately they conned the public in a referendum several years ago to go off that standard, and they paid off debt with US dollars that they sold in gold, basically at below, at the $200, $300 an ounce level. So the Swiss franc does actually still correlate the most with gold out of any currency, because there's various speculation as to how much gold is actually left in Switzerland, but it's possible that perhaps 20% of the money is still backed by gold in Switzerland. So when gold rallies, you don't really want to be in a short position of the Swiss franc. But looking at the 60-minute chart here, it's been holding the Tenkan line, this is the daily chart. It's been holding the Tenkan line great and continues here. It has to catch up to the cloud. Right now, not really too sure if I would want to be long this point. We could wait for a better entry point just because gold rallied a bit recently. And here, looking at the 240-minute chart of the Swiss franc, it's touching the cloud, it's holding on, but MACD is turning down. The stochastics, I use the 21, 3, and 3, and you can see down here it's passing below the 80, so it's not necessarily the greatest entry point here on the Swiss franc to go long USD CHF, which is actually short the Swiss franc. This is the US dollar Canadian pair, and this is a pair that's usually overlooked, but it can really trade well when oil is rallying quickly or oil is falling quickly. And the reason is because Canada is a resource-based economy based primarily on oil. The United States gets 10% of its oil from Canada. It's the most out of any country, more than Saudi Arabia, Venezuela. I believe Venezuela is second. So when oil prices are high, the government has greater revenues through taxation, and then they don't have to borrow as much and increase the money supply. So when oil is high, government doesn't borrow, money supply grows at a slow rate, so the Canadian dollar is strong. When it's the opposite case, when oil falls, the government may go into deficit and increase the money supply, Canadian dollar drops. So as long as oil is falling and the trends look good, I think it's a good trade to go long US dollar Canadian. But if oil continues to rally, then it's probably not a trade you're going to want to be into. Here briefly is the 60-minute chart on the pound sterling short to the US dollar. So we're short the GBP USD, and this actually had the highest trend ranking on my system. And here we go, it touches the cloud and boom, we're at a low of several weeks now. This may be an all-time low. It's almost an all-time low or yearly low. The problem with the pound is that we do have a new prime minister now who plans to cut spending, but he has a coalition with a leftist leader as well who probably wants to increase spending. But it is all about the perception of the money supply growth or the money supply getting smaller. I'm sure the money supply in Great Britain is going to get bigger over time, but just at a slower rate than expected under Labour. But regardless, you don't want to be long the pound at all at this point. It has the highest negative trend ranking on my system that I'm tracking. And that's your currency update for today, June the 8th, 2010.